Every decade or so, the market does something that feels unbearable while you are living through it and embarrassingly obvious once it is over. It collapses. The headlines turn apocalyptic. Experts begin speaking with the special confidence people reserve for disaster. Friends stop asking what to buy and start asking whether they should sell everything. Good companies get priced as if they have lost their future. Ordinary people feel sick when they open their accounts. And somewhere inside that chaos, a strange thing happens. A small group of regular people, not geniuses, not insiders, not hedge fund stars, begin quietly building life, changing wealth, not because they are fearless, not because they know the exact bottom, not because they have secret information, because they understand one simple truth that the crowd forgets every time panic arrives. When fear gets big enough, price and value stop being close relatives. That is the heart of this whole story. The source document you gave me understood that. What it was really saying was not, here comes easy money. It was saying something much more serious. Every once in a while, the market hands ordinary people a rare kind of opening, a moment when emotional liquidation pushes prices so far below long-term reality that patient buying becomes one of the most profitable acts a normal person can make in an entire decade. That is the pattern. And because it is a pattern, not a fantasy, it deserves to be taken seriously. Let me begin where the source began. With a picture, it is 2009. The world feels broken. Banks are failing. Homes are being lost. People are terrified. The news is not merely bad, it is terminal. Everywhere you look, the tone is the same. This is not a dip, not a recession, not a rough patch, but a permanent wound. That is how it always feels in the middle. Not temporary, total. And when things feel total, the human instinct is not to lean in. It is to run. That is why most people miss the best buying periods of their lives. Not put as they do not know the market has historically recovered, but because recovery is hardest to believe in exactly when the prices make the most sense. That is the paradox. The opportunity arrives wearing the costume of disaster. The people who bought during that 2009 collapse were not buying because the world felt safe. They were buying because they had enough emotional distance to separate headlines from underlying productive reality that matters. Because Apple did not suddenly become a bad business just because fear cut the stock price. People still wanted the products. The company still had a future. Amazon did not become worthless because the market was in panic. The S&P 500 did not represent 500 broken businesses. It represented a country having a financial seizure. Those are not the same thing. And if a person can learn the difference, he can completely alter the financial arc of his life. The source pointed to the extraordinary returns that followed those crisis lows. And that is exactly the right place to start because people need to feel the scale of what is being discussed. A $10,000 investment in a broad market index near the 2009 bottom became many multiples of itself over the following years. That is not legend, it is arithmetic. And the important thing is not only the result, it is the type of person who could have captured it, a teacher, a nurse, a construction worker, a man with a normal job and normal fears and a normal family budget, but who had enough preparation and enough discipline to act when other people were emotionally frozen. That is why these periods matter so much. They are the few moments when the market's emotional dysfunction can temporarily level the playing field between institutions and ordinary citizens. Not permanently. Temporarily, that is enough. Now go back further, the dot-com collapse. This is one of my favorite examples, because people rewrite that era too neatly after the fact. Today everyone talks as if it was obvious that the internet would win. It was not obvious in mood. It may have been obvious in long-term direction, but mood and direction are not the same thing. Mood is what determines price in the short run. Direction is what determines wealth in the long run. When the technology bubble burst, people did what they always do after an excess has humiliated them. They overcorrected. They went from irrational love to irrational disgust. That is the emotional rhythm of markets. First, greed tells you nothing can go wrong, then fear tells you nothing can go right. And both voices are liars. The man who bought after the collapse was not buying a slogan. He was buying the future at a price fear could tolerate. That is an entirely different act. The source used Amazon as an example, and it is a good one because it shows how ridiculous the gap between price and long-term reality can become when panic takes over. But I want you to understand the deeper lesson beneath any one stock. The deeper lesson is that markets regularly take real businesses, put them inside unreal emotional environments, and then offer them to the public at prices that make sense. Only if you assume the fear will last forever. Fear never lasts forever. That is not optimism. That is human nature. The panic always feels eternal then. Eventually it is not. Go back even further. 1987, Black Monday, one of the most psychologically violent market events in modern history, a one-day collapse so sharp, it made people feel as if the financial system itself had become unstable in real time. The source was right to mention brokers crying at desks. That matters because it reminds us what panic looks like when it is alive. The atmosphere is not analytical, it is animal. In those moments, human beings do not see bargains, they see threat. Their nervous systems do not distinguish between a stock quote and a predator in the grass. That is why buying in a crash feels unnatural. You are asking your body to do the opposite of what it evolved to do. You are asking it to move toward what the herd is fleeing from. That is why the strategy is simple in principle and brutally hard in practice. Everyone says buy low and sell high, but low only feels low after the danger is gone. In the moment, low feels like maybe this goes lower. Maybe the experts are right. Maybe this time really is different. That sentence, "this time is different," is one of the most expensive sentences in the history of investing, because every real crash has conditions that are, in fact, different in detail. That is not the issue. The issue is whether those differences permanently destroy the productive engine of the economy or merely create a temporary emotional overreaction around it. Most of the time it is the latter, and that is where fortunes get built. The source kept coming back to a point I think deserves even more respect than it usually gets. Regular people become wealthy during these windows, not because they outsmart everyone else, but because the crowd becomes so emotional that simple good behavior suddenly looks extraordinary. Think about how strange that is. During normal times, buying an index fund and holding it does not feel like genius. It feels boring. Then a crash comes, and the exact same boring behavior begins to look courageous, almost radical, because everybody else is doing the emotionally obvious thing instead. That is one of the great hidden truths in finance. A huge amount of extraordinary wealth is built by ordinary behavior performed at emotionally difficult times, not by brilliance, by emotional independence. Now let us ask the central question. Why does this pattern keep happening? Why do markets crash so violently and then recover so persistently? The answer is not mysterious. It is human psychology, greed and fear over and over again in different costumes. When markets are rising, greed expands the future. People begin paying too much for stories because they no longer feel the need to be careful. Then a shock arrives. Sometimes it is a financial crisis, sometimes a recession, sometimes war, sometimes inflation, sometimes a pandemic, sometimes the popping of a prior bubble. Then fear takes over and does the opposite. It shrinks the future too much. And when fear is strongest, price drops faster than business reality deteriorates. That is the key. If a stock falls 40%, it does not necessarily mean the business became 40% worse. Often it means human beings got 40% more frightened. That distinction is everything. The source said this well through examples like Apple and Amazon during crisis periods. Did the product stop mattering because fear was high? Of course not. Did the ability of large productive companies to generate revenue disappear overnight? Of course not. What disappeared temporarily was the crowd's willingness to pay anything remotely close to fair value. And whenever fair value gets abandoned in the direction of fear, opportunity is born. This is what Buffett means when he says to be fearful when others are greedy and greedy when others are fearful. People quote that line all the time because it sounds wise. Very few live it because it demands emotional behavior that feels terrible in the moment. Being greedy when others are fearful does not feel triumphant. It feels lonely, it feels nauseating. It feels like walking against the direction of a stampede and praying the herd is not seeing something you are missing. That is why I think the source did the right thing by bringing in real ordinary people instead of only famous investors, Veronica the teacher, Alex the construction worker, Jessica the nurse. Whether every detail of those stories is documented or stylized is not the main point. The point is the type of person. These are not men and women sitting on a trading floor with proprietary models. These are ordinary citizens who prepared enough cash, studied enough history, and controlled their emotions enough to act when the crowd could not. That is the lesson. Not that you need genius, that you need a plan before panic comes. Because once panic arrives, emotion becomes stronger than intelligence in most households. That is why the source was absolutely right to say the real preparation must happen before the crash. Not during it. During the crash is when the test happens. Before the crash is when the answer sheet is written. If you wait until the screen is red and the headlines are screaming to decide what your philosophy is, you will not have a philosophy. You will have a nervous system. And the nervous system wants safety, not opportunity. That is why ordinary investors must decide now, while things are calmer, what they will do the next time. Fear goes systemic. Will they have cash ready? Will they know what vehicles they trust? Will they focus on diversified index funds instead of pretending they can identify the one perfect stock under maximum emotional stress? Will they invest all at once or average in? Will they understand that they may not catch the exact bottom and do not need to? These questions matter more than any hot tip, because hot tips do not survive panic, frameworks do. The source emphasized that you do not need a finance degree to do this. That is correct. You need three things far more than you need a degree: a long enough time horizon, a diversified enough vehicle, and emotional behavior strong enough to follow the plan when every headline invites you to betray it. That is the real barrier, not complexity, discomfort. The source also made a critical statistical point: major crashes, real crashes, not the routine little wobbles people call crashes on social media, tend to happen every several years, often around once a decade in serious form. That means a person may only get a few truly extraordinary buying windows in an entire investing lifetime. That is why they matter so much. You do not need to be a hero every month. You do not need to forecast every CPI print, every rate cut, every election, every twist in every sector. But if you can recognize one of these rare panic windows when it comes, and you have the discipline to lean in with a real plan, the financial effect can be enormous. That is what most people miss. Wealth is not only built in steady annual drips. It is often accelerated during rare periods of mass mispricing. And those periods always feel worst when they are happening. That is why so few people capitalize on them. Now I want to spend time on something the source hinted at but did not fully develop, and it matters enormously. Buying in a crash is not the same thing as gambling on a bottom. Those are very different behaviors. The fool says, "I think today is the exact low." The disciplined investor says, "Prices have fallen enough, fear is large enough, and my time horizon is long enough that expected long-term value is improving here." That is a far more mature way to think. You do not need precision. You need asymmetry. You do not need to hit the bottom tick. You need to buy at levels where future returns become meaningfully more attractive because the crowd has overreacted. This is one reason I like the source's emphasis on dollar cost averaging during fearful environments. That is a good discipline for ordinary people. Take the total amount you are willing to commit and divide it into pieces. Invest some now, some later, some if prices fall more, some if the panic intensifies. That way, if the market keeps dropping, you are not emotionally destroyed because you went all in too early. And if the market recovers sooner than expected, you still participated. This is how adults handle uncertainty, not by demanding precision from a system that does not offer it, but by creating structures that remain intelligent across a range of outcomes. That is what regular people need, not heroic structures. Now let us talk about what to buy. The source was very wise here too. Do not try to be a hero. Do not pretend you can identify the next Amazon every cycle. Most professionals cannot do that with consistency. They have teams, access, models, management calls, and still most of them underperform over long stretches. So why should an ordinary person operating under emotional stress in the middle of a crash suddenly imagine that he will become an elite stock picker? It is vanity. Buy the whole market, buy the productive engine, buy broad index exposure, SP 500 funds, total market funds, simple, low-cost diversified structures. No one is impressed by them at parties. That is fine. The goal is not to impress people at parties. The goal is to build freedom. And broad index funds have done more to create quiet millionaires than almost any flashy vehicle people like to brag about. That is the truth. Boring has a very strong track record. Boring also helps emotionally, because if you own the broad market, you do not need every single company to survive. You need the productive economy over time to keep doing what productive economies have historically done. That is a much safer psychological position than trying to guess which one stock will be the savior. Now, I want to address risk honestly, because the source did, and that gave it credibility. Yes, investing during a crash is risky, of course it is. Companies can fail, markets can stay ugly longer than you hoped. The economy can weaken more than expected. Prices can go much lower after you buy. Anyone who denies that is selling comfort, not truth. That is why certain rules matter. Only invest money you truly do not need for several years, preferably longer. This is not rent money, not emergency money, not money you will need for next year, tuition or next month's taxes. Long-term money, money that can remain untouched long enough to give recovery a fair chance. That distinction is everything. The person who buys with short-term money often becomes a forced seller. The person who buys with patient money becomes the beneficiary of other people's forced selling. That is a profound difference. The source also mentioned borrowed money through the example of Alex. I want to be careful here. Borrowing to invest can work. It can also destroy people. It should not be treated lightly. If someone uses leverage, he must understand exactly how he will service it, even if the investment drops sharply and stays weak longer than expected. That is what separated a calculated risk from a stupid one. Most people should avoid borrowed money bravado entirely. There is no shortage of opportunity without adding a noose around your neck. Now let us turn to the present moment, because this is where the source was trying to create urgency. It pointed to recent years of volatility, expensive markets coming down to earth, certain growth names falling dramatically, and fear beginning to creep back into the environment. Whether this exact moment is the exact low is not knowable. That is not the job. The job is to recognize when conditions begin shifting from euphoric pricing toward fear-driven repricing. That is when attention matters. The source was right about one thing especially. By the time the news feels comfortable again, by the time your friends are bragging about gains again, by the time television hosts sound relaxed again, much of the easy recovery money has already been made. That is always the problem. People want confirmation before they act. Confirmation is expensive. It comes after prices moved. That is why investing rewards emotional courage more than people think, not reckless courage, structured courage. The kind that knows discomfort is the admission price. The kind that understands the first part of the recovery often happens while the mood is still terrible. Look at history, the biggest one. Year bursts often come off terrible lows. The market can rise explosively long before life feels normal again. That is why waiting for comfort is such an expensive habit. Comfort is a lagging indicator. Price moves first. Emotion catches up later. This is one reason I want ordinary investors to become much more serious about building a watch list and a framework before the next real panic arrives. What would you buy? How much cash or dry powder would you want available? What percentage decline in broad indexes would make you start paying close attention? How would you phase in? What accounts would you use? How would you stop yourself from doom scrolling every hour instead of executing the plan? These are real questions, and answering them before the storm is how a person turns fear into future wealth. Now, I want to say something else the source was getting at, and it may be the most important point in the whole piece. The crowd always gets the cycle backwards. The crowd buys safety. The crowd sells fear. The crowd confuses emotional comfort with good expected returns, but comfort and return are often inversely related. When everything feels easy, the price usually reflects that ease. When everything feels terrifying, price often reflects too much terror. That is why wealth is not built by emotional agreement with the crowd. It is built by understanding cycles better than the crowd does. Cycles of greed, cycles of fear, cycles of compression, cycles of recovery. And if you can recognize that the market is not a morality play but a repeated psychological machine, then crashes stop looking only like destruction. They begin to look like transfer points, moments when emotional money is forced out and patient money can move in. That is what happened in 2009. In 2002, in 1987, in 2020. That is what will happen again. Not with the exact same headlines, not with the exact same companies, but with the same basic human script. The source ended by asking a simple and useful question: when the next crash comes, will you be one of the surprised people or one of the prepared people? That is the right question. Not whether you can forecast everything, not whether you can call the exact bottom, whether you can expect the existence of fear, prepare for it, and use it instead of obeying it. That is the difference. Because the people who profit the most from crisis periods are rarely the people who saw it coming, in some prophetic sense. They are the people who understood that crashes are part of the architecture of markets, not violations of it. They knew it would come in some form. They kept liquidity, they kept perspective, they kept their time horizon, they kept a plan. Then, when fear made price ridiculous, they acted. This is why I think the source's deepest truth is not about any one period. It is about the recurring shape of opportunity. Every generation gets a few moments like this. Moments when the market offers future returns at prices that look absurd only because present emotion is so loud. Most people will waste those moments. They will stare at the screen, read the headlines, talk themselves into caution, tell themselves they will buy later when things stabilize, then the recovery will come, then they will feel safer, then they will buy higher, then years later they will say they wish they had bought in 2026 or whatever the year happens to be, just as people now say they wish they had bought in 2009 or 2020. The wish is always late. Preparation is what matters. So I would tell any ordinary person this: you do not need genius. You do not need insider access. You do not need heroic forecasts. You need long-term cash. You can truly invest. You need a diversified vehicle you actually understand. You need a phase in plan. You need the discipline to keep your hands steady when your stomach feels weak. And most of all, you need to remember that the market's best long-term bargains almost never feel like bargains while they are happening. They feel like danger. That is why so few people capitalize on them. That is also why they are worth so much. Because if it felt safe, everyone would do it. And if everyone did it, the prices would not be there. That is the final lesson. The rare periods that create a great deal of ordinary wealth do not come dressed as invitations. They come dressed as fear. The question is whether you know how to recognize them.